Welcome to Voice Daily Finance, the most important news personalized for you every day. Supported by Voice.com.
Today, we've got three major stories for you. First up, we're diving into the $3.1 trillion tidal wave of money from the world's family offices. They're creating a shadow banking system by pouring capital into private credit and data centers. Then, we'll pivot to the massive sell-off hitting European AI adopters like Capgemini and Sage, and explore why Nvidia CEO Jensen Huang's prediction that AI will eat software is coming true right now. And finally, we'll look at the tech IPO market. It's back with a vengeance, and we'll examine if this frenzy is a market comeback or a repeat of the 1999 crash. The most unexpected news in the finance world today has to be the tectonic shift being driven by a quiet but colossal power. The number of family offices, the exclusive investment firms for the ultra-wealthy plowing billions into private markets has exploded by an incredible 524% since 2016. And no, that's not a typo. 524%. The pace is only accelerating, surging nearly 21% in 2023 and another 26% in 2024 alone. This wave of capital now totals over $3.1 trillion, completely dwarfing the growth of traditional players like wealth management firms and university endowments. So the thing is, this isn't just about chasing high returns. It's a deliberate exodus from the public stock market. It's the constant pressure of quarterly earnings reports, the threat of shareholder activists, the sheer weight of regulatory burdens. All of it makes public companies less attractive for long-term value creation. Research shows that the average age of a company going public has jumped from just 4.5 years to over 12. And why? Because there's now an ocean of private money that lets them grow without public scrutiny. For years, their game plan was simple. Use their multi-generational timelines to escape the daily whiplash of the stock market, investing in illiquid assets for stable, long-term growth. This is where the situation takes a more complex turn. Just as Wall Street got comfortable with these giants snapping up private equity deals, a stunning pivot is underway. New intelligence from a UBS survey shows they are becoming far more selective. In fact, many are now planning to actively trim their private equity bets. So where is that $3 trillion tidal wave of money flowing now? They're doubling down on private credit and infrastructure. And this is critical because when we say infrastructure, we're not just talking about bridges and roads. A huge chunk of this money is flowing into the digital backbone of our society. Data centers, the global data center market is projected to more than double to over $500 billion by 2032. This means a handful of private family dynasties are becoming the new unaccountable owners of the cloud and the infrastructure that powers artificial intelligence. It raises serious questions about who controls our digital future when it's in private hands with little public oversight. They're shifting from owning companies to becoming the lender. What's really happening here is that they are effectively creating a multi-trillion-dollar shadow banking system. As this money floods into private credit, it operates outside the view of many traditional regulators. The International Monetary Fund is already sounding the alarm, noting that the private credit market has swelled to over $2 trillion, mostly in the US. A study from Moody's Analytics even warns that the hidden connections between this private debt and the regular banking system could seriously amplify the next financial crisis. This isn't just a minor portfolio tweak, it's a fundamental change in strategy from the most patient and powerful capital on earth. This all leads to the question, what happens when the world's richest families decide to become the bank instead of the buyer? Who wins and who gets left holding the bag? All market information is subject to change and volatility. This content is for informational purposes only and does not constitute investment advice. Now, while that quiet revolution is happening in private capital, a much louder one is shaking up the public markets in Europe. The AI revolution is starting to eat its own. European companies that bet big on artificial intelligence are now getting hammered with a massive sell-off hitting the very firms investors thought were safe. To understand what's happening, you have to look at the fundamental difference in how Europe has approached AI compared to the US. Research shows that between 2018 and 2023, European AI companies attracted about 32 billion euros in investment. In that same period, US companies pulled in over 120 billion euros. This has created a dynamic where Europe has become fantastic at adopting AI, but has fallen behind in in creating the foundational models themselves. In 2024, Europe produced only 3 major foundational AI models, while the US produced around 40. So these European giants built their strategies on integrating AI, not inventing it. And now the pace of invention from others is outstripping their ability to adapt. Since mid-July, shares in the markets and data group LSEG have plummeted 14.4%. UK software firm Sage is down over 10%, and French IT consultant Capgemini has been rocked by a 12% drop. And this is all happening while the broader European markets are actually up. And you might be wondering why a consulting firm like Capgemini is getting hit so hard. After all, its core business is human expertise. But new research suggests that generative AI can automate up to 70% of the repetitive, data-heavy tasks that consultants do, from analysis to documentation. This directly threatens their entire business model. So what's going on? The very technology these companies embraced is now threatening to make them obsolete. The release of incredibly powerful new models, like OpenAI's GPT-5 and Anthropic's Claude for financial services, is sending shockwaves through the market. One fund manager put it bluntly, saying with every new AI version, the market's thinking, oh wait, that challenges this business model. This completely upends traditional business planning. How can a company map out a multi-year R&D cycle when a single new AI model released overnight could make their entire strategy obsolete? The new rule for survival is agility. Companies are being forced to abandon rigid long-term plans for fluid, scenario-based strategies that can pivot in a moment's notice. This brings back a chilling 2017 prediction from Nvidia CEO Jensen Huang. AI is going to eat software. That idea is no longer a distant theory. It's playing out in real time. The core fear is that these new AI tools will become so capable they can simply do what expensive software and data analytics firms currently charge for, effectively wiping out their business. However, if you zoom out, you'll see another layer to this. For years, the ultimate defense for a tech company was its unique proprietary data. But now, even that might not be enough. As one analyst warned, I just don't think data is a big enough moat anymore. The reason this is so significant is that the very definition of a competitive advantage is changing before our eyes. The new AI models are trained on colossal public data sets, eroding the value of any single company's private data. So the new moats are things like AI, governance, and strategic partnerships. Most importantly, it's about how deeply and quickly a company can integrate AI into its core innovation. For example, Samsung has created an AI native approach that gets new products to market 47% faster with higher customer satisfaction. That's the new battlefield. It's not about what data you have, but how fast you can use AI to act on it. This sell-off is creating a clear divide between potential winners and losers. Some see this as a chance to buy the dip on companies that can adapt, but for others, the clock is ticking. The question on everyone's mind is no longer if AI will disrupt the industry, but which giants will fall first. Speaking of market upheaval, while some established tech players are stumbling, the next generation is rushing to go public. The tech IPO market is back with a vengeance. And it all kicked off with a software company named Figma, whose stock jumped 250% on day one. And it's not an isolated event. Crypto firm Circle soared 168% in its debut, and another exchange, Bullish, finished its first day up 84%. Now, get this. Despite all the regulatory uncertainty in the digital asset world, investors are flocking to these stocks. Why? They might see them as a less volatile, more regulated way to get exposure to the crypto space without buying the coins themselves. Think about it. Circle stock more than doubled, and Bullish saw its valuation explode to over $13 billion. Investors are signaling huge confidence. After 3 years of a frozen market, the floodgates for tech IPOs are officially open. And this isn't just a random thaw. Some experts are calling this 3-year freeze a period of forced maturity. Startups couldn't just burn cash for growth anymore. They had to become efficient and focus on actual profitability. So the argument is that the companies going public now are fundamentally stronger. On top of that, with regulators making it much harder for big tech to simply buy up smaller rivals, an IPO has become one of the only paths left for a big payday. Interestingly enough, not everyone is celebrating. Some of Silicon Valley's biggest names are furious. One top venture capitalist is calling these massive gains an expected and fully intentional giveaway, accusing Wall Street of being addicted to handing easy money to their clients at the expense of the companies themselves. The situation presents a fascinating duality. On one side, you have the classic accusation that banks deliberately underprice a stock to guarantee a big first-day jump for their preferred institutional clients. But on the other, the game has completely changed. A huge part of that first-day surge is now driven by everyday investors. Research shows that IPOs with high levels of social media hype can see initial returns almost double those without it. The catch? The same research shows these hype-driven stocks tend to significantly underperform in the long run. The debate is raging. Are these fair prices, or is it a rigged game? The head of the NYSE says immense demand could open the floodgates, and the Nasdaq CEO confirms a very healthy list of companies are lining up to go public. There are reportedly more than 24 private tech companies valued at over $10 billion each, just waiting for their turn. But if that was just the appetizer, the main course is the warning now coming from one IPO advisor who compares the frenzy to the end of Prohibition, saying, folks, in some cases, are drinking to excess in the IPO market. She says the gap between what institutions pay and what retail investors pay is a situation we haven't really seen since 1999 and 2000. Her final words are chilling, and of course, we know how that ended. So the question is, with a massive backlog of billion-dollar tech companies waiting in the wings, are we witnessing the greatest market comeback in a decade or the prelude to the next great crash?
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.